Always great to have you here, Chris. And looking forward to your presentation. It's up already. Thank you.
Thank you.
Clicker is here.
Clicker's here. Perfect.
Yeah.
Got it. Awesome. Okay, perfect. Good morning, all. I hope you can hear me. As Eugene said, when I saw him this morning, he asked me if I was ready for the presentation. I was going to respond and say I was born ready, but it was a bit too corny to start the morning on that note. So as he said, Chris Reddy, I'm a portfolio manager and head of trading at All Weather. The good thing about not being first off on these presentations is all the good stuff is presented by the guys previously. So hopefully I can just give you the highlights reel in terms of some of the things that we're seeing in the market and how we're looking at investing. If I can just leave one slide with you, I think this is the exact summary in terms of the key things that I'm going to be discussing with you today. So in summary, we think that there are good reasons to be positive around globally emerging markets. I think international investors were shocked to see the true extent of the tariffs that came through in April of this year, and many are now looking at ways of actually protecting clients' wealth and looking at diversifying away from the US markets. We think that this 15-year bull run in the US is coming to an end, and investors are now looking away from diversifying from these Mag 7, NASDAQ, S&P, and the likes. South Africa has had an exceptional start to the year. We'll unpack why we think that that's potentially going to continue from these levels and hopefully start spilling into other sectors of our economy and our stock markets. One of the benefits of if we do see EM inflows, that will also filter through into South Africa because South Africa is about 3% of the MSCI EM index. We think there are good reasons as well to be positive our domestic shares. Yes, it doesn't seem that apparent when you look at the performance of our domestic shares being retailers, insurance, and banks year to date. But I'll unpack why we think that the performance has lagged some of our commodities and other rand hedges year to date. And then we'll touch some of our stock picks as well. One of them actually being JSE as well, so I'm happy Simon actually touched on that in his presentation. So quickly before we go into that detail, I think one of the processes that we have implemented over the past couple of years is also incorporating macro into our investment process. Yes, we are fundamentally bottom-up stock pickers, but I think in this environment where there's a lot of volatility, as Pagelo has already mentioned, you need to be cognizant of what's actually happening from a macro point of view. If you take this year as a case in point, a lot of the resources run that we've seen, whether in gold or in PGMs, has also been a factor of both the geopolitical risk, which is linked also to this weaker dollar, Trump's policies around the Fed and the likes. If you didn't have that view around a weaker dollar outlook, you probably would have missed this resources rally in our precious metal shares. Coupled with the macro geopolitical overview, we also are very cognizant of investment flows in our market as well. So as Simon mentioned around the illiquid nature of the JSE, when large managers are trading in our market, they will have an outsized impact, whether they're buying or selling. We use that to our advantage because if they move it away from what we think is a fair value for the company, we will take the opposite side of those trades, and it just requires a bit of patience to wait for that to actually play out in our markets. In terms of the two ideas that I want to discuss as well, we've launched a global emerging markets fund in 2018, so we're running about 6-year track record. We're in the process of also launching a SA feeder fund rand denominated through BCI and Eugene and the team. We think that it is an attractive asset class, especially given our view around flows starting to move away from the US into gems. That's where the growth is going to be coming for the foreseeable future. And we are overweight China in that fund. Year-to-date performance has also been very good. We're running at about 6% ahead of the USD benchmark in that fund. We also launched a Best Ideas equity fund. As a house, we were previously a benchmark cognizant house. A lot of clients came to us and said they were looking for a more concentrated, actively managed fund, and that's why we launched the Best Ideas Fund. It takes our best ideas from our hedge fund and our long-only product, typically runs between, say, 15 to 20 ideas, but high concentration bets. So to an extent, similar to what Simon was talking about, where you've got quite a high tracking error, big bets per position to really go for that alpha generation over time. Again, good performance since launch. We're running at about 33% over the past 12 months in that product. Okay, so just recapping in terms of those key themes that I discussed earlier, why we think EM, the time for EM is now. As I mentioned, April was a shock to many in the financial markets. You saw what happened with bonds. You saw what happened with the dollar. There was basically no place to hide if you were running a balance fund. The dollar was weaker. U.S. treasuries were also weaker. So the safe haven plays did not do as expected. Your balance funds also actually lost capital in this period. And you saw a flight to safety with gold, even the likes of Bitcoin running as well in April. We think that the world is moving from unipolar to multipolar. And what we mean by that as well is that previously, if you're an SA investor, 4 things were constant in your life: debt, taxes, a rand depreciating, and investing in the US market was going to earn returns for your clients. Those conditions, 2 of those conditions no longer are relevant. Debt and taxes still around. But we think that as investors start tilting their portfolios more towards EM markets, South Africa will be a net beneficiary of that. And you can see it in the chart that I'm showing you over there. So the 3 lines there, MSCI SA, these are all dollars. MSCI SA has actually been the best performing market, has actually outperformed the MSCI EM index and also outperformed your S&P and NASDAQ. Now, yes, we know a large chunk of that has been driven by the resources rally. I'll unpack that as well. But we think if you expect the dollar to continue to remain weaker given Trump's policies with the Fed, we just think that gold continues to run from these levels. We touched all-time highs this morning, $3,690 an ounce. That will also start filtering through into platinum as well, because obviously dollar-denominated commodities. We think that China still has good growth ahead of it. And also, if you look at how China compares to, say, the Mag 7s, it still trades at a deep discount for similar equivalent type of AI exposure. And that can also be seen with regards to how well the likes of Tencent and Alibaba have performed. Behind that as well is also a very supportive domestic economy, with Chinese investors sitting on almost $23 trillion worth of cash. So as they've been moving that into the equity market, that's been the major driver of those markets, and they're not actually reliant on foreign flows for now to drive those markets. The final point is that global managers are also underweight EM. So as you get this wall of money, should they join this party, there's going to be a wall of money leaving the US and starting to go into gems, which will also then potentially support those asset prices. I won't spend too much time on this chart, but basically what it says is it's a quote from Rich Newsom from Mercer. So he's a global asset consultant. And they were just highlighting the point around what happened around April, where asset consultants had basically no place to hide at the start of the US tariffs. And they were all now re-looking at their long dollar, long US positions to see how can they actually protect capital going forward, and what does it actually mean for diversification for their clients' funds. I'm sure SA advisors are also asking the same question, because that has been the go-to trade for many advisors, and they're now looking at other opportunities. Quick slide to just talk about from a valuation point of view. So you can see what I'm talking about, that 15-year bull market in US equities. This is just US S&P 500 over the emerging markets index. And you can see it's been a straight line down for EM versus the S&P 500. So the trade has done very well. The blip that we've seen at the bottom there just shows you the true extent of what is possible should we start seeing these EM flows coming through. Similarly, at the bottom as well, the dollar has been the go-to from a currency perspective. I think the Russia-Ukraine crisis, as well as what Trump is doing now with the Fed, potentially puts that into question. And we also know that he's basically forcing the BRICS countries to start engaging more actively with one another to potentially look at reducing the dollar's dominance as a global currency, with them potentially looking at a BRICS currency, and also now moving more and more towards commodities, gold in particular, as their store of value instead of US treasuries. Quick slide around what I talk about by fiscal dominance. This is our key concern that we've got with the US. So in the past, it was a monetary dominance economy where the Fed was independent and there was a clear focus around inflation. As you can see right now, for the past couple of years, the Fed has actually missed their targets around their 2% inflation targets. And there's a lot of pressure coming through around that board with regards to bringing through cuts. We do think that we probably see a 25 basis points tomorrow. If it's more, I think you're going to see a bit more pressure around that dollar, and also more pressure on bond yields in the US, which again is going to filter or put more fire into that commodities support, so gold and PGMs in particular. So we're slowly moving more and more towards this debt crisis as the US continues to borrow to fund that economy. Couple of slides in terms of just what does the landscape look like. So the US currently is about 27% of global GDP, but it accounts for 64% of the MSCI World market cap. 64% of MSCI World market cap, whereas the top 5 EMs account for 25% of the global GDP, but they only account for 88% of the global market cap in the MSCI World. So massive disparity around just the relative positions over there. If you look at China, so this just highlights the chart I was talking about, where you look at China Internet trading at roughly about a 15% forward versus the Mag 7s that are more than double that at a 30% forward. And what you've seen of late is that the go-to shares in the likes of NVIDIA haven't actually been providing that blowout earnings or analyst surprises at the recent results, which talks to potentially them being quite toppish at these levels. Amazon is our number one share that we hold in the fund from a valuation point of view, from an AI exposure point of view, as well as just generally operating performance cash flows that they're generating as well. So you can see with the recent results that they've had, bless you, Amazon is currently trading at about, I think it's about 150 Hong Kong dollars. We started the year at about just over 100. So you can see that Chinese support coming through to actually buy the share and support the share. The image on the right-hand side is what I do when I'm bored in the evening. If you can't see the images there, what I'm showing you is for each of the various sectors in the Chinese economy, whether it's automotives, semiconductors, consumer brands, and digital services, what we've seen over the past couple of years is a consistent trend of Chinese supporting Chinese companies. So there's been a move away from buying from the Western or developed market companies and supporting the locals. And that can be seen with regards to the sales that global companies are having in China. So if you look at, say, Tesla or Porsche, Porsche at some stage, China was probably about 30% of their global sales. It's now probably mid-teens, if that. And the locals for the likes of BYD, Xiaomi, which basically makes the equivalent of a Porsche for $35,000, has been eating up a lot of that market share for the Western companies in China. Similarly, if you look at the semiconductors, Cambricon, if you do yourself a favor, look at the chart of Cambricon. It's basically going vertical and makes gold look quite tame in comparison. But they basically make a semiconductor chip as well to compete with the likes of NVIDIA in China. Even in SA, you're seeing a similar dynamic with regards to the amount of Chinese vehicles on our road. There are some forecasts of them potentially getting up to about a 30% market share over time. And it's quite clear if you look at just the value on offer. Even if you were to throw away the Chinese vehicle, you're still going to lose less money on that trade versus the depreciation on some of your German brands. And you're still getting 1 million kilometer warranties and the likes. So that's the trend that's happening in China. We think it's going to start happening in SA as well, especially on the auto side. Quickly recapping around China, you can see the point I mentioned around the $23 trillion worth of cash. That money is now going into the stock market, and that's actually driving that investment boom that we're seeing in China. I won't touch on too much around that, but just in terms of the basics around asset allocation. So this is some work that Goldman Sachs did around what is the optimal allocation to emerging markets. And based on their analysis, they target, or they say that based on an efficient frontier, you should have between 20 to 30% of your portfolio in EM. Investors are sitting at single digits at the moment. So there's still quite a bit of money to flow into that trade. I know I'm running out of time here, but I want to just discuss this one slide in particular. So when anybody looks at the JSE, it's been a phenomenal year on our market. This is a graph that we put together that basically unpacked what have been the drivers in the JSE year to date. And you can see this is probably till the end of July, early August. 10 shares have accounted for 95% of the return on our index, the bulk of them being resources, and then a splattering of rand hedges being Naspers Process, and you've got some BTI and MTN, which is driven off the back of the strong Ghana and Nigeria numbers. So while this looks great from a returns perspective, what this unfortunately does for the rest of the market is that it does pressure a lot of the domestic sectors. Because what we've seen in our market is going into 2025, many of the large domestic managers that drove the rally post-GNU were overweight the domestic sector. So they were buying our retailers, buying our banks, and buying our insurers. They came into 2025 with those overweights. They were underweight resources. So when we had this rally in the precious metal shares, the only way to fund those underweights or close those underweights were to sell down the domestic shares. And that's part of the reason why the likes of our retailers, banks, and insurers have actually struggled year to date as local money switched into chasing this resources rally. We do think that many of the managers are now at weight or getting closer to at weight on these precious metal shares given the various placements that have happened, Valterra in particular. And we are hoping that once these retailers start producing results, you're going to start seeing this operating performance coming through strongly that supports the valuation that we're seeing it. And of late, you can see, for example, First Rand, Outsurance had excellent results yesterday. We're waiting to see what happens with Pepco as well once they report in November. But you're going to see this dislocation between the good quality companies that are strong management teams that are performing well versus those that were just lifted with the tide with the GNU flows from last year. Won't spend too much time on this, but I know I'm over time already. But just to recap in terms of one of our top picks in the portfolio, this is Pepco. Why we like the share is that they've got market-leading performance in the value category, which, as you know, if you look at the RLC data, it's been one of the more defensive plays in our market. What the market is not appreciating, I think, is just the value or the growth that's potentially going to come through from their fintech business that's being Flash, as well as their credit offering as well through Connect. I think the dynamic around Pepco of why it's underperformed is you had the IBEX placement, and a chunk of the IBEX placement went to creditors. And what we've seen in the market is that once the creditors got those shares, they started selling that into the market post the placement. So you've had this two-stage overhang into our market. But we think Pepco at just over a 13 times multiple, it's about 0.5 times more than Mr. Price, is probably the most attractive consumer play that we've got at the moment. Management are aligned with shareholders. I mean, Peter Erasmus basically bought just over 1.5 billion rand worth of shares as of last month at 27 rand. So we think going forward, this is the one to hold now that the overhang risk has been removed and the company can actually just perform on its own without the IBEX/Steinhoff thing around its neck. And then just to recap in terms of the performances, as I mentioned as well, this is our best ideas performance since launch. Eugene, I think that's me. If there's any questions.
Many thanks, Chris. I just want to check quickly, questions from the audience. The clock caught us a little bit, Chris. I know you're sticking around for tea time. So if any of our audience members you want to engage with Chris, more than welcome. Chris, thank you so much for being here this morning.
Cheers.
Bye.